This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 401 was produced on November 9th, 2023. I'm Eric Townsend. Goehring and Rosenzweig co-founder Leigh Goehring returns as this week's feature interview guest. Leigh and I will discuss the relationship between monetary policy and commodities investing. I'm also going to be doing a webinar today, Thursday afternoon, November 9th, at 4:30 p.m. Eastern Time for our friends Mike Green and Harley Bassman over at Simplify Asset Management. That webinar includes a live question and answer segment. So if you hear this in time to attend the live webinar, you can register using the link in your Research Roundup email. If you missed the live webinar on Thursday afternoon, November 9th, there should be a replay available on the Simplify website, and we'll post that link in next week's Research Roundup or whenever it's available. Speaking of Harley Bassman, Harley's new ETF for trading the mortgage-backed security strategy that Harley described in his September 14th MacroVoices interview began trading this week under ticker symbol MTBA. We'll have a full update for you in our postgame segment.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, November 8th, 2023. The S&P 500 December futures were up 336 basis points to 43.99. A material short squeeze to the upside. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The U.S. dollar index down 117 basis points to 105.52 remains in consolidation after putting in short-term highs the other week. The December WTI crude oil contract down 382 basis points, closing at 77.37. We'll take a look at that chart in the post game. The December RBOB gasoline down 229 basis points to 213. December gold down 146 basis points, closing at 1958, correcting after a very strong October month. Copper down 27 basis points to 364. The price action remains subdued and the trend remains weak. Uranium down 215 basis points to 72.85, and the U.S. 10-year Treasury yield down 24 basis points, closing at 4.50, rejecting that 5% level in October and now deeply mean reverting. The key news to watch this week is the University of Michigan consumer sentiment. Next week we have the monthly November option expiration, the CPI and PPI inflation, retail sales, and Empire State Manufacturing Index. This week's feature interview guest is Goehring and Rosenzweig's co-founder, Leigh Goehring. Eric, why did we get Leigh back on the show as a guest this week?
Patrick, we recorded this interview a few weeks ago because interest rates and therefore monetary policy matter a lot in commodities investing. In the last few years, it's been so easy to forget that. And I'll actually share a rather embarrassing story with our listeners. Last year, when I went to roll my position in gold futures from the December 22 contract to the December 23 contract, I was shocked by how much contango existed in the market. And I actually embarrassed myself by tweeting publicly saying, what the hell is going on with storage costs on gold? It doesn't make any sense. It was our friend Ola Hansen who tried to help me save face by politely responding saying, Eric, interest rates are back. Did you forget? That contango is all about interest rates and carry cost. Well, it's actually pretty embarrassing, but after years of near zero interest rates, I literally, despite being a Series 3 commodity trader, I literally forgot that carry cost is mostly about interest rates back when you have interest rates. And boy, they're back with a vengeance, aren't they? If I could make such a foolish mistake, I've got to believe other people could as well. So this interview is all about understanding why interest rates are so important in commodities investing and how they affect the shape of the commodity term structure.
Well, Eric's interview with Leigh Goehring is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Goehring and Rosenzweig co-founder Leigh Goehring. Leigh, it's great to have you back on the show. We've got an exciting topic that's a little off the beaten path for today's show, which is the connection between commodity prices and changes in monetary policy regime. Now, I'm sure a lot of listeners are going, what? Why don't you start by explaining what does commodity prices have to do with monetary policy?
That's a really good question, Eric. And the answer is I really don't know. However, as I'll explain as I go through my talk today, is that we're now entered into a situation where commodity prices are radically depressed relative to financial assets. And in fact, they've never been more depressed than where they are right now. And if you go back over the last 120 years, which really represents the modern, financial world that we live in, there's only been 3 times previous to this instance where commodity prices have been this depressed.
Now, what do you mean by this depressed? Depressed relative to what?
Relative to financial assets, and primarily, say, just use a broad index like the Dow Jones Industrial Average. And what you do is you look at the returns of what commodities have produced relative to the level of the stock market, and going all the way back to 1900, that it turns out that, like I said, there's only been 3 periods previous to this where commodities have been as cheap relative to financial assets, in this case represented by the Dow Jones Industrial Average.
And what were those 3 periods?
The 3 periods were the late 1920s, the second period was the late 1960s, and the third period was the late 1990s. And then you have today, which is basically represented starting in like 2019 to 2021.
So you're making the assertion that although you may not have a specific causal explanation for why it's happening, you're looking at when these depressed commodity periods have happened. You're scratching your head saying, hey, wait a minute, late 20s, that's kind of when the Depression started. Late 60s was just before we had a massive inflation in the United States. Late 90s was just before the tech bust. And it sounds like you're then making the connection. Wait a minute, it's monetary policy that gets changed. Aren't there a lot of other things that get changed? I mean, we've had World War II happened. It seems like there's lots of things. You could say that commodity prices bring wars on.
And that's true. But I think that, if you want to think about it expansively, one of the things that's interesting about each one of those periods, which I just described, the previous 10 years, previous to 1929, previous to 1969, previous to 1999, the financial backdrop included a very, very large bear market in commodity prices. And that bear market in commodity prices did 2 things. One thing is it really prevented commodity companies, that is the producer, the mining companies, the oil and gas companies, that prevented them from generating enough cash to reinvest back into their businesses, which of course set the stage for the upcoming bull market. But one of the other things that took place is that each one of those periods, because the backdrop took place with a big commodity bear market, there was no source of inflation during those time periods. And what each one of those periods, that commodity bear market allowed the Federal Reserve in each one of those periods to run very, very loose monetary policy. Now, what that monetary policy did was that it allowed in each one of those periods a period of intense financial speculation to take place. Obviously, the 1920s was the massive bull market that took place there that was characterized by huge speculation on massive amounts of borrowed money in the new technologies of the market. That was radio, that was, appliances, it was the automobile companies. They were the equivalent of the AI companies of today. The 1960s, monetary policy was very loose. They could because commodity prices were very, very depressed. There was no inflation from that source. And it allowed the Federal Reserve to run a very, very expansionary monetary policy that helped President Johnson, finance both the Vietnam War and his Great Society programs. And there's all those very famous pieces written about how poor McChesney, who was the chairman of the Federal Reserve Board, how he was dragged into Johnson's offices and berated to constantly lower interest rates. So also, what did that monetary loose monetary policy bring forth? It brought forth a huge period of intense speculation, very similar to what took place in the 1920s. You had the conglomerate phase. You had the mutual fund gunslinger craze, characterized by, personalities such as Jerry Tsai. And ultimately, it wound up producing the Nifty 50 craze in the early 1970s, where you had basically 50 stocks that all traded at PEs of 50s that became known as the one decision stocks. You only made one decision, that was to buy them and you never to sell them. So the thing is that each one of those periods was characterized by intense, loose monetary policy that wound up producing intense levels of financial speculation. And maybe what it is that it's that loose monetary policy brought in with the intense speculation ultimately undermined each one of the financial regimes, and those regimes had to be replaced.
It seems to me like you're focusing on monetary policy regime, but really from what you're describing, it sounds to me like we're really talking about cycles in interest rates. When interest rates are really low, that enables a lot of speculation. If commodity prices are low, that it kind of makes sense that would happen. Why are you focused on monetary policy as opposed to just interest rate cycles as the driver for this?
It's interesting. You look at the level of interest rates back in, say, the late 1920s. I mean, it's hard to compare them with the interest rates today, where we actually have zero rates, and we actually had 17 billion, or was it $30 billion of sovereign debt that traded at negative rates. We never had anything like that in the late 1920s. But you do look at the monetary growth and excessive monetary growth that took place in each one of the cycles. And that's a characteristic that's reemerged every time. And like I said, in the 1920s, it was the fact that Benjamin Strong, who headed the New York Federal Reserve and set monetary policy, Britain tried desperately to go back on the gold standard at the pre-World War I rate. And so that meant that they had to deflate their economy, or the United States had to inflate its economy in order to make that pound exchange rate viable. So Benjamin Strong in 1924 aggressively lowered, U.S. interest rates to try to inflate the U.S. economy in order to enable Britain to go back on the gold standard of the pre-exchange rate in 25, which they did. It wasn't enough. Benjamin Grant in 1927 had to aggressively go out and buy treasury bills again and try to lower interest rates and expand the money supply, inflate the U.S. economy in order to allow Britain to remain on the gold standard. Again, it wasn't enough. And by 1930, it was all over. Britain just had to leave the gold standard altogether. And that was the major change in monetary regimes. And how did it wind up in U.S. policy? Well, by end of 1933, Roosevelt devalued the dollar, not by 10%, not by 15%, not by 20%. He devalued the dollar by 60% in the end of 34. That was massively stimulative to commodity prices. So that's the type of monetary regime change that I'm talking about. And that happened again big time in the late 1960s. We forget about this, but pre-February 1968, the Bretton Woods Agreement said the U.S. would back each dollar in circulation with 25% gold. And so with the very, very loose monetary policies that were being expressed by the Federal Reserve in the 1960s, there was a massive outflow of gold outside of the U.S. Treasury. And to the point where the U.S. could no longer, in the winter of 1968, honor its gold backing of the dollar. So what did Johnson do? He suggested that Congress pass a law to remove that gold backing, and they did. And that was the beginning of the great commodity bull market of the 70s. That's, if you go and look on a very close basis, that's when commodity prices turned and ended their bear market. Now, the big event happened back in I think it was September of 1971, when Nixon surprisingly removed the U.S. from the Bretton Woods gold exchange standard and let the dollar float for the first time. And that was massively inflationary and a massive boost to commodity prices.
Now, as I think about commodity prices and the role that they play in the financial system, most people would say, look, over the long haul, you're better off investing in the stock market than in commodity markets because the returns are better. If I look at what you're saying here, well, the late 1920s, that's just before the 1930s. That was a period where stocks did horribly. Commodities actually did better than stocks in the 1930s. Likewise, if I look at the 1970s, that was just a horrible, horrible time for the stock market. Wonderful time for at least some commodities. Early 2000s, at least early 2000s, we had the dot-com bust and so forth. Really bad time for stocks. Yet the early 2000s, right around 2001, gold was bottoming. Gold's not necessarily a proxy for other commodities. I'm not sure what copper was doing off the top of my head back at that time, but I wouldn't be surprised if it was quite a bit lower than it is now. So it seems like what you're saying sort of, presages, okay, maybe the next decade, the 2030s, should be, or the late 2020s, should be a really good time to be long commodities. Is that right?
That's exactly right. And you can argue whether you should be invested on a commodity as a commodity investor on a long-term basis. There's pros and cons to that argument, depending on the fact that the asset classes are inversely correlated, and you can combine them together to provide portfolios that significant long boost their Sharpe ratios and things like that. But X all that stuff that you would read in the Journal of Portfolio Management, what you want to do is you want to significantly increase your exposure to commodity and commodity related equities at a time when commodities are cheap. And we believe that we're in one of those periods right now. In fact, we would say that commodities are as cheap as they have ever been. And every time you do this, 1929, 1968, 69, 1999, 2000, every time you do this, you have done near spectacularly well relative to all other asset classes. We've done this. For example, we've actually looked at this. If you had composed a portfolio right at the top in September of 1929, a portfolio of 25% energy equities, 25% gold-related equities, 25% metal-related equities, and 25% agricultural-related equities. That portfolio by 1940 would have increased by 175%.
Now, hang on a second, Leigh. I want to understand why you're focusing on commodity-related equities. If I look, for example, at the bull market in gold that began in November of 2022, the metal has done fantastically well. The mining shares have not done very well because everybody's worried about a resurgence of inflation. If inflation comes back, it means that the commodity producers are going to be facing high costs, just like everybody else is. And although the price of the commodity is going up, it may be that the profitability of the producers is not quite keeping pace with the price advance in the commodity. So why wouldn't you invest, since it's so easy to invest through ETFs and commodities directly, or through the futures market if you're a professional, why wouldn't you invest in the commodity rather than the commodity-related equities?
Oh, there's a very simple explanation for that, and I'm going to give you a great example. Remember, when you're a commodity investor, one of the great headwinds that you have to overcome is what they call the roll problem. That is, future commodity prices usually are higher than today's commodity prices. And that's the contango. And when you buy commodities, you have to pay that contango, and that's a cost that you have to incur over time. Now, it's like, for example, the oil market is backwardized right now. So you're actually getting paid to own physical oil, which is unusual, but that just goes to show you how dangerously tight the oil market is, even though we're all wildly bearish. However, I'll give you a good example. Buy the Goldman Sachs Commodity Index in 1999. Sell it in 2010. Buy a portfolio, that same portfolio that I just talked about, 25% equities in energy, in base metals, and precious metals, and agriculture. That portfolio of equities by the end of 2010, basically the top of the bull market, that's gone up by like 350%. Do you know what the Goldman Sachs Commodity Index returned during that time period? Zero, zero, zero. That's what the roll yield does to you over time. And that's why, everyone says, well, why don't you buy the commodity? Is that there's incredible costs that are associated with owning the commodity. And you don't have that. In fact, it's sort of just the opposite. On a theoretical basis, companies can sell forward their production and actually capture the contango. And where you as the investor, you enter into the Goldman Sachs Commodity Index, you're going to pay that contango. That's why it pays to own the equities over time, maybe not on a short-term basis. Like you said, Gold equities are now underperforming gold stocks, but I suspect that's going to gold, the physical metal, but I suspect that's going to change.
Okay, so returning to your core thesis, the idea here is that at times when commodity prices are as low as they are as today, we should expect there to be a change in monetary policy regime. Boy, for a lot of other unrelated reasons, it makes a lot of sense to me that now would be a good time to reconsider the way that we do monetary policy. Are we talking about a technical change that the FOMC has a committee meeting and changes their process, or are we talking about something much bigger, like a political change where, let's say, maybe the Congress starts to question the dual mandate of the Fed and changes the directives that the Fed is given? What kind of level of change are we talking about?
The pressures are going to come from outside and not from within. And I'm talking about a monetary regime change that could be as monumental as what we saw in 1930 and as monumental as we saw in like 1971. And, obviously 30 was Britain had to leave behind the gold standard. And that was the end of the gold standard. 71 was the end of the Bretton Woods dollar gold exchange standard. And I think that this change could be something as monumental as the US begins to lose its reserve currency status. And that would be as monumental as what happened in 1930 and as what happened in 1971. But it would be outside political powers of the United States. It would be something that would be chipped away by actors on the global stage. The question is, you're beginning to see this already. Like, for example, there's been huge talk over the last decade about the US losing its reserve currency status, except the thing is that even though there's been talk about it, and the fact that the US does abuse its reserve currency status, is that there's been no movement on anyone to try to undermine it, or no movement by anyone trying to replace it with something. Now, for the first time, we're beginning to see funny things begin to creep up. And actors on the global stage are trying to aggressively put in place a different currency regime. And what I'm referring to is first is that you saw the announcement that Brazil announced that they want to settle all their commodity trades done with China in renminbi, or that Saudi Arabia is exploring selling its oil to China in renminbi, or the fact that Total, one of the big global LNG players, liquefied natural gas players, is willing to settle its LNG sales to China in renminbi. You have to take this seriously, because who was the person that did it in the Bretton Woods dollar gold exchange standard? It was de Gaulle in the mid 1960s. He ranted and raved. He took all his excess dollars. He brought them to the Treasury, the Treasury's exchange window, and said, "Give me gold." And he was the one that really started to undermine the Bretton Woods gold exchange standard. It eventually collapsed in 71. Are we beginning to see this take place now on the fringes, just like de Gaulle was a fringe actor in 1965, 66? But the thing is that it eventually occurred, forcing a monetary regime change. Are we beginning to see the same thing now?
Let's apply some of the current social events and attitudes to what you're describing, because if I've understood you correctly, you're saying this is not just a question of FOMC making a policy change. You're talking about there being pressure on the system where politically there's pressure to change the way we do things. So what are the political themes that seem to be popular right now? Certainly, it seems like some kind of debt jubilee is on a lot of people's minds, particularly in the United States, at least with respect to student debt. But generally, it seems like if you saw a populist movement to influence monetary policy, it would probably be toward some kind of debt jubilee. Likewise, if I look at the social attitudes, there's more and more talk about reparations and transfer payments, and redistribution of wealth seems to be more and more of a popular theme these days in political circles. How do those things affect your prognosis for markets, and particularly if some of those things, like let's say a debt jubilee, were to come into this equation? Maybe it starts as a student debt jubilee that a bunch of people feel like, hey, me too. I don't have any student debt, but I still deserve a break. Oh, okay, we're going to give everybody up to a certain amount of debt relief. What would that do to your forecast in terms of commodities and other markets?
I think it would hasten and bring forward everything that I've just said. When you think about what are the needed preconditions for someone to have a reserve currency, that the currency has to be financially viable and financially stable. And the idea that everything you just mentioned, Eric, debt forgiveness, populist expansions of reparations, all these type of things are ultimately going to undercut the value and stability of what the dollar represents. It's only going to make people more hesitant to basically use a global dollar-based system, of which the US is a massive beneficiary of. So everything that you just said I would think, is bearish for the future of the dollar.
So your outlook is generally commodity positive for, it sounds like, the next decade. Is that the time horizon?
Yes, and in fact, we've written about, and I've spoken a lot about, is that we're very much, I think, repeating the decade of the 1970s. And that the commodity bull market started, like I said, with Johnson removed the gold backing of the dollar back in '68. That was the start of the commodity bull market, and it rose quietly. People still speculating in financial assets all the way to 1971, and then when Nixon took the U.S. off the Bretton Woods gold exchange chart, bang. That's what really started the bull market. And between 1970 and 1980, oil rose 11-fold in price. And that's the type of moves that I believe are going to happen this decade. And the funny thing is that, okay, so this bull market is the equivalent, started in 2000, 2001. That's the equivalent of 68. So the thing is that this bull market will easily run to 2030, or into the very first several years of 2030. So the thing is that, yeah, I think that this decade is going to see huge capital flow into the commodity area, and we're beginning to see it. Commodities have been the leader. They pulled back ever since the March of 2022, but I suspect that they will resume leadership soon.
You say that we're looking at a repeat of the 1970s. Well, the two assets that come immediately to my mind from the 1970s are gold and oil, simply because those are the ones that were up the most in that decade. Does that mean that gold and oil are the thing to bet on and for the next decade, or is this one of those cases of the generals always fighting the last war, and we need to think about different commodities being in play this time?
No, I think that those two commodities will again emerge as the leaders in this bull market, and the underlying fundamentals would say that they should be leaders in this bull market. And I mean, for example, the gold market, one of the interesting things about gold is it started in the 1930s at $35, I'm sorry, the 1970s at $35 an ounce, and it peaked in January of 1980 at 850. So that was an increase of 24 times. You can make the case that we are almost as radically undervalued at gold today at 2000 that we were when gold was $35 back then. So the thing is that
Now, how do you make that argument? What's the basis of that?
this is very interesting. We've written about this extensively over time, and if you ever want to see a funny article, I could pass it on to you. I was profiled in Forbes magazine in May of 2000. Gold is $275 an ounce. And I I said, they said, what is your target for gold? And I said 2000. And I thought, it's the headline of the article. The headline is gold 2000 question mark, question mark. And 275, that sounded preposterous. But by 2011, it hit 1900. And the funny thing, how did it get there? Well, if gold is money and the Federal Reserve prints a lot of dollars, there's some loose relationship between all that dollar printing and dollars in circulation and the amount of gold that's outstanding. And we've done that calculation. And back in 2000, with gold at 275, it said, given the fact how much gold the Treasury holds, how much money had been printed, that there was a chance in the next decade that gold would appreciate to 2000, which it did. Using that same methodology of the relationship of the size of the Federal Reserve's balance sheet and the amount of gold that the Treasury owns, which is, I think, 265 million ounces today, is that basically gives you a dollar gold price of something between 15,000 and 25,000. And you say, well, that's incredible. How can that be? But it's happened before. It's happened before. And it'll happen again. It's just you have to have a change in psychology. That's all, which is going to happen.
So would you go so far as to making a call to say gold $20,000 by 2035?
I would say 15,000.
Okay, so $15,000 gold by 2035 is your call.
Yep. Yep.
And what about oil?
I would say that oil. I know that you said you've had quite a few people on your program that have talked about concepts like Hubbard's Peak and things like that, and I won't go into it. But we are definitely going to switch the psychology towards oil markets from this concept in our minds that oil is in structural surplus all the time, that oil is going to go into structural deficit. And the reason why we flip that psychology is that over the last 12 years, the preponderance of oil supply growth in the world has come almost exclusively from the US shales, and the rest of the world has stopped growing. And the thing is that we do a lot of work on the shales. Uh, we probably do more work than what anyone else does. And we come up with vastly different conclusions of what's happening in the shales. And we believe that the shales have rolled over, and including the last area of growth of the shales is the Permian Basin. We believe that the Permian Basin is going to peak in the next 6 months to 8 months, and then we'll be by the end of 2024, we'll probably enter into decline. So the only source of oil supply growth in the world is disappearing, and so that's going to flip the market from structural surplus to structural deficit, and it's going to have a huge change. The psychology towards oil is going to change. And of course, it's interesting. We live in this incredibly bearish world of oil. I mean, the IEA came out with this grand pronouncement which they've been now saying since 2019, that oil demand is going to roll over, and we have this whole concept of peak oil demand occurring right now. And I can guarantee you that is not going to happen. We are going in exactly the opposite direction. And I think my partner Adam might have talked to you on your program about that. The idea that the underlying structural forces at work to increase energy consumption are exploding. The IEA and a lot of people believe that oil demand was going to had peaked in the fourth quarter of 2019, and we would never see that level of oil demand again. Well, it looks like by the end of this year that we're going to hit 104 million barrels a day, so we're going to be over 3.5 million barrels higher in 2023 than we were in 2019. And the underlying growth trends are strengthening, contrary to what everyone's saying. So the thing is that we have this idea that oil demand has rolled over. It's not. It's actually strengthening right in front of us, and we're changing the complexion of supply. So where does oil go? I don't know. Oil will spike to a level which balances supply and demand, and whether that's 160 to 180 or 200, I don't think it can stay over 200.
Leigh, I want to come back to your core thesis and particularly what you've said about the currency, because you've described that when you get the kinds of situations that you're detecting in the commodity market now, what tends to happen is a big monetary policy regime change. Let me lay a really big monetary policy regime change on you, the one that I predicted in my book in 2018, which is that the U.S. dollar will eventually lose its reserve currency status to a surprise competitor. And the reason that I expect this to take everyone by surprise is the entire financial market has always assumed that we have this financial engineering problem, which is nobody can figure out a way to match the depth and liquidity of the U.S. Treasury market, not the dollar itself, but the U.S. Treasury market, because it's U.S. Treasuries, the dollar-denominated debt, that provide the instruments that are useful to central banks as reserve assets. So everybody's assumed until you can replace the liquidity and depth of that U.S. Treasury market, there's no way to ever displace the U.S. dollar. And I agree with them, at least in the sense that until you can match that depth and liquidity of the U.S. Treasury market, you can't replace the U.S. dollar. What I think a lot of people miss is that if you're talking about a digital currency system, Now that's not a financial engineering problem. It's a software engineering problem. And you have a lot more options and avenues as to how to address it. So suppose that Russia and China are a little bit, have their act a little bit more together than people are giving them credit for with this new BRICS currency system that they've talked about. Suppose that their intention is to launch a CBDC, a central bank digital currency system, which is more centralized than something like Bitcoin, but is still a bona fide digital currency system. And they assert that to become a competitor to the US dollar, but they used software engineering instead of financial engineering in order to create the liquidity and depth characteristics of a digital sovereign bond market that can compete with the depth and liquidity of the US dollar treasury market. That to me is the potential what could happen in the next 10 years. That's my huge kind of outlier. And it has nothing to do with commodities, despite the fact that I'm a commodity trader. As I listen to what you're saying, it sounds like the monetary regime change that you're expecting is kind of in line with what I've just described, although I don't know if you were expecting it to be quite that big. Am I crazy? Is this crazy talk? What do you think?
No, and it's not. Because everything you said, Eric, is exactly true about you need to you have to develop an asset class that has liquidity, and it's something that you can fall back on to basically use to balance trade related current account imbalances. I would put forth something a little crazy. I mean, you're looking forward to a new sort of a new age solution. I would say,
I'm not looking forward to it, for the record. I'm just predicting it.
yeah, that I would say that it could very well take a bizarre form that it falls back on another style of currency that is incredibly old school and incredibly old fashioned. But see, the thing is, you're beginning to see this happen as well, and that's using the global gold markets as a method to balance currency imbalances, trade related imbalances, and and you see it. For example, obviously China would love everyone to trade all their trade in renminbi, but the problem is that China has a closed capital account. So you accumulate a lot of renminbi, there's nothing you can do about it. And except if you want to go to Shanghai and buy a palace in Shanghai, which no one wants to do. Um,
But you can buy gold in the Shanghai Futures Exchange.
Exactly, exactly. And they're already facilitating that type of situation where if, for example, I'm Brazil and I sell all my soybeans and I sell all my iron ore to China and I receive this huge amount of renminbi, and the amount of renminbi I receive is greater than what I buy in goods from China, then what do I do with the renminbi? Well, as it's structured now, I can't do anything. I've just got this excess renminbi. Well, what happens if I go to the Shanghai Gold Exchange and I say, okay, I'm willing to take this renminbi and buy gold, and you ship me the gold. And I can use the gold market as a mechanism by which I settle out my trade imbalances. And it's so funny. You can say, "Well, that's really crazy. That's really old world." But think about it this way: Brazil in the first quarter of this year bought an additional 7 tons of gold. However, what people forget is that Brazil in 2022 doubled their gold holdings. The central bank doubled their gold holdings. What is Brazil thinking? What is Brazil doing? Are they preparing themselves to this idea that they're going to start using gold as this mechanism to balance out renminbi trade imbalances with China? It looks like that's the direction they're going. And it's interesting. A lot of these, Singapore, now even India, which has traditionally not been a gold buyer, has bought a significant amount of gold in 2022 and again in beginning this year. So the funny thing is India thinking about beginning to settle its trade related imbalances with gold with China? It seems like we seem to be wanting to go in that direction. So whether that's the form or not, I don't know, but it's something to watch very, very closely.
Let me run another question or scenario past you as I've pondered this question of a digital currency designed by challengers to the U.S. dollar's hegemony over the global financial system for the purpose of displacing it, displacing the United States from holding that hegemony. As I think about this, I can think of a couple of directions it could take. One is that they could develop a gold-backed central bank digital currency so that they kind of say, look, let's embrace old school monetary concepts will have a new age digital currency, but it'll be backed by gold. So everybody who thinks that way will kind of, have their intellectual needs appeased or placated, so to speak. The other way that I could see this going is that they say, gold served its purpose in its day, but now it's just shiny metal. If we're going to back our system with something, we should back it with energy or something that's more tied to what the world really needs, as opposed to something like gold, which was really chosen just because of its scarcity and the fact that it was easy to carry back in the day. Depending on which way that goes, I could imagine it having very, very different outcomes on the gold market and potentially on other markets. So, as we think about this possibility of the U.S. dollar losing its reserve currency status to something else, how much does it matter whether or not that something else is gold backed?
I think that adding gold as a backing to anything gives it more underlying underlying acceptance, in the sense that gold is, even though it obviously got eclipsed by the cyber currency craze that emerged at the early part of last decade and continues in various forms to today, that I think that gold, it could very well emerge as an asset class that has every attribute that we would find attractive in either backing a cyber currency or as a method by which, like I said, trade imbalances are settled out. And it's interesting. Like I said, whether this happens, I don't know. We have to follow the evidence that's emerging. And I mean, I forgot to mention this before. One of the strange things is China has bought now gold for 6 months in a row. And it's significant. I mean, some of those quarterly gold purchases have been as high as I think 25 tons and things like that. So now China all of a sudden seems to be on a huge gold accumulation phase. Why are they doing this? Why all of a sudden are they gravitating towards this idea that they'll be using the Shanghai Gold Exchange as a method by which renminbi conversion take place? Could be, could be.
I think China and Russia are jointly scheming to develop a digital currency system, and at least a possibility that I'm sure they're considering is backing it with gold. I wouldn't be surprised if they're also considering backing it with energy, which I think would be a more logical way to develop a modern age commodity-backed monetary system. What other possibilities should we be thinking about that could be on the horizon?
As far as monetary regime changes,
Yes.
um, it's a good question. Something that could happen, for example, the U.S. loses its reserve currency status because at some point we reach a tipping point that the total amount of debt that the United States has is unsustainable. And we experience something which no one would expect, like a failed auction. When these treasury bill auctions that are taking place are so huge, what happened if it occurred during a period of financial turmoil, some geopolitical event, and the US had a failed auction? And failed auctions have happened repeatedly in the history of government and finances. And usually what happens is in every one is the central banks wind up buying part of those issuances. And of course, that begins the direct monetization of debt. And that's when mass inflationary problems started. So maybe it's the United States slips into a severe inflationary problem that actually begins to become uncontrollable. And the idea that it would be centered around the fact that it can't roll over its short-term debt, and the Federal Reserve winds up buying it and monetizes it directly. Maybe that's going to be the monetary regime change. The US will have massive dollar devaluation that takes place because of hugely rising inflationary expectations. Maybe that'll be the regime change. But again, that would be massively positive for US holders to own commodities. That would be massively positive because that would be the way that you would protect yourself against that dollar depreciation.
Own commodities or own commodity related equities?
Both. I would say commodity related equities to help. I would say own physical gold.
Okay, physical gold and commodity related equities.
And physical silver if you have the ability to do so.
I can't thank you enough for a terrific interview, but before I let you go, please tell us a little bit more about what you do at Goehring and Rosenzweig, because I think most people think that you guys are a research firm. That's really not accurate, although your research is very highly respected in the industry. There's a lot more to what you do.
No, that's exactly right, Eric. A lot of people assume that we're just a commodity-related and natural resource-related research firm. That is not what we do. Our primary function is we manage money. We're an SEC registered investment advisor. We run the Goehring and Rosenzweig mutual fund, which is you can call your broker up and buy it.
What's the
And
ticker symbol?
G is in Goehring, R is in Richard, H is in Harry, I is in Indigo, X is in X-ray, GRHIX.
GRHIX.
And that's for the institutional class, and the retail class is GRHAX. A is in Abram. So
GRHAX for retail class. Got it.
and I should point out that our research, that is the basis for the way we manage our money in natural resource markets. We are all research related, and that research is in the public domain. And you can all access it by just going to our website and downloading it. And as I heard my partner Adam say to somebody the other day, he said, and we don't remove our old letters. So obviously, when you look to the future, there's some calls that you're very proud about, and there's some calls that you become somewhat embarrassed about how wrong they are. They're all there for our readers to follow.
And that's at GoRosen.com.
GoRosen.com.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com. Energy Transition Crisis, my new video documentary series about energy transition, has finally been released, and anyone can watch it for free at energytransitioncrisis.org. The series explains exactly what it's really going to take to break humanity's addiction to fossil fuels and why it will take longer and cost more than almost anyone realizes. And I'd like to think the 3 episodes on nuclear energy are among the most detailed on YouTube. This is a passion project for me, and there's no profit motive, no revenue, and therefore no budget other than donations. I'd really appreciate your help promoting the series. Things you can do to help include subscribing to the Energy Crisis Doc YouTube channel, liking every episode, posting comments on YouTube, and posting links to your favorite episodes on social media. If you don't have time to do those things, there's also a donations page at energytransitioncrisis.org. The money does not go to me. 100% of it will be spent on YouTube and other social media advertising to promote the series. Thanks in advance for your help. Now let's get back to the show and Patrick's post-game chart deck.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, it was great to have Leigh back on the show. Now, joining us again in the post-game segment is Nick Galarnik. Now, let's get to that chart deck. Listeners, you're going to find the download link for the post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, that means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Leigh's picture saying, looking for the downloads. Now, Eric, let's get to crude oil.
There was no EIA inventory this week due to what they described as a system upgrade. I'm not sure exactly how it's an upgrade to not have the data, but that's what they called it. So we'll have EIA data for you next week. Meanwhile, API reported a build on inventories, which of course is a bearish sign, and needless to say, the market action was very much bearish this week. As Lord Keynes famously said, when the facts change, I change my opinion. And the facts are definitely changing, as is my opinion on the risk of a major upside move in oil prices. But let's start by breaking down what's happened in the last week. On Friday, Hezbollah announced just before the U.S. markets opened that it held the United States directly responsible for the violence in Gaza and vowed that the United States would, quote, pay a very heavy price after explicitly acknowledging the U.S. Navy assets in the Mediterranean and saying they would not deter Hezbollah from making good on its threats. But then oil sold off $3 on the day, evidencing that the market is ignoring those threats. On Sunday's futures open, OPEC Plus and Russia both confirmed intentions to extend production cuts through the end of the calendar year. That was obviously bullish, and the market responded with a $1.50 rally in the Asian and European sessions, but still sold off hard in the U.S. session to close approximately unchanged on Monday. The real carnage in oil markets this week started in the overnight session after Monday's close, when both gold and oil nosedived as war hedges collapsed, signaling that the market agrees with several of our recent guests that my own concerns about military escalation are misplaced. The 100-day moving average was taken out to the downside early in the Asian session. A brief attempt at recovery began with the European Open, but didn't last. And by the end of the U.S. session on Tuesday, WTI was down more than $5 from its peak on Monday morning, after the bullish news from OPEC Plus and Russia. It's not clear to me exactly when the news first broke that both the United States and the European Union were now pressuring Zelensky to make concessions and negotiate a peace agreement with Russia, reversing their prior commitments to support Ukraine in its fight to the end, no matter what it takes. But it is clear that this news played a big role in bringing on the onslaught of selling in both crude oil and gold as geopolitical risk hedges utterly collapsed. I suspect those moves also triggered algorithmic CTA funds to short oil and gold, and that activity helped accelerate the downside move in prices. By the close on Wednesday, Brent was below $80, and WTI had briefly tested a 74 handle after slicing through both the continuation and contract 200-day moving averages like a hot knife through butter. The market closed on Wednesday well below those 200-day moving averages, portending the risk of further downside still to come. Remember that even Dr. Anas Al-Haji, who disagreed with my concerns over military escalation, told us that he expected OPEC Plus to defend $80 Brent, and we hit that level on Wednesday. There isn't much in the way of technical support levels below Wednesday's close before you get to the 200-week moving average, all the way down at 69.93. So if OPEC Plus or Saudi Arabia is going to intervene, they better do it quickly to avoid even more downside carnage. Taking the opposite view, our friend Rory Johnston tweeted on Wednesday a strong warning that he thought a cut from OPEC Plus was foolish, wishful thinking on the part of crude oil bulls. Rory argued that, if anything, a fourth production cut this year would support the bearish argument that the supply imbalance is actually opposite what everyone, including Rory, thought it was, i.e. too much supply rather than not enough to meet demand. Even more bearish news emerged Wednesday when it became clear that a disagreement had formed between Biden and Netanyahu, who reportedly ignored Biden's request for a temporary ceasefire. Secretary of State Blinken later remarked publicly that an Israeli occupation or annexation of Gaza was not an acceptable resolution to this situation. From my perspective, the market took this as a reversal in President Biden's prior unconditional commitment to support Israel no matter what. And I'll be the first to say that Israel getting into a military conflict with Iran by itself doesn't pose much risk to global oil supply. The risk was from the United States being involved in a major conflict with Iran that would risk direct warfare escalation between the United States and Russia. And this rift between Biden and Netanyahu seems to have calmed any remaining fears that such an escalation was possible. All this obviously forces me to reevaluate my own concerns about a full-on military conflict between the United States and Iran developing, and potentially evolving to a United States-Russia direct conflict. Frankly, I still think the market is badly underpricing that risk, but recent market events have caused me to recognize that the risk probably isn't nearly as imminent as I first thought it was. With 2 aircraft carrier battle groups, a few guided missile cruisers and destroyers, and at least 1 Ohio-class cruise missile nuclear submarine, all pointing their weapons directly at Iran as a deterrent, it's no great surprise that Iran is in no hurry to escalate a military conflict with Israel, at least not right here and right now. But I'm still quite convinced that neither side can ever forget what has already happened, and that Hezbollah has made it crystal clear that they will hold the United States directly accountable for the loss of life in Gaza. So I remain convinced that Hezbollah and/or Iran will make good on their threats to seek revenge against the United States. But it would make much more sense for them to accomplish that goal by infiltrating the United States through its open southern border and then planning and executing a terrorist event on American soil long after all the U.S. battleships have left their present station in the Mediterranean. That would still lead to a direct military conflict between the United States and Iran, which could easily escalate to direct conflict with Russia. But it would happen long after the basket of calls on March 24 WTI futures that I was holding would have expired in mid-February. So the change in my own geopolitical risk hedging strategy has been to diagonal roll my calls to lower strikes and later expiries, to give all of this more time to play out. A couple more news events went seemingly unnoticed by markets on Wednesday. Yemeni Houthis engaged in conflict with Israel claimed victory for shooting down an American MQ-9 Reaper drone, and hours later, U.S. warplanes conducted attacks on eastern Syria. Messaging from the White House was vague about exactly what acts these air raids were retribution for, but the point is, U.S. forces are still very much engaged in this conflict, regardless of the reported spat between Biden and Netanyahu. Separately, Russian Foreign Minister Sergei Lavrov made comments to the effect that the United States was risking a major Middle Eastern regional war by its actions of supporting Israel. So while the oil and gold markets seem to have completely forgotten about any risk of escalation to direct military conflict between the United States and Russia, it's crystal clear that Russia has not lost sight of that possibility and remains concerned by it. And as I said last week, my view is that the world desperately needs more spare capacity to leave room to compensate if significant supply is eventually taken offline by military events in coming months or years. So if Saudi Arabia, either independently or through OPEC Plus, further cuts production to support the market here, I will salute them for doing so. Rebuilding spare capacity is critically important, and prices are now low enough to allow doing so. But at the end of the day, all of these events add up to demand a change of my own opinion that a major escalation with Iran before mid-February, when my out-of-the-money calls would have expired, was the more likely case. Now, I still see that possibility as entirely plausible, but it's no longer my base case, and I'm repositioning accordingly. I've already taken a big loss on my basket of out-of-the-money calls on the March WTI crude expiry, and I'm now diagonal rolling that position into a smaller-sized basket of calls with lower strikes and later expiries. I remain steadfastly convinced that the market is being too complacent here, and that Hezbollah and Iran will eventually make good on their promise to seek revenge against the United States. But that could take a year to play out, so betting the farm on $150 oil prices by mid-February just doesn't make sense anymore. We're already at a price level where OPEC Plus intervention is entirely possible. But without it, I think there's likely to be more downside still to come, unless the geopolitical situation re-escalates, which is also entirely possible. A smaller number of calls, much closer to the money, makes much more sense given this change of the facts.
Eric, what a breakdown on that 50-day moving average. I was looking for a retest of the $80 level, which was where the 2023 highs were. But this selling has truly intensified. It may just be the fact that everyone was so positioned bullishly on oil due to the escalation of events that it's really easy to squeeze everyone out. What will be really the big tell for me is going to be in the next week whether if this was just a big washout of buyers, then we should see the price rebound back to $80 quickly. The way I look at it is the longer we spend below $80 on a sustained basis, the more likely that the bull phase has paused and we're going to go back into some sort of a trade range that was established all year long. With that said, let's move on to the equities. Eric, what do you see here on the S&P?
The 100-day moving average at 44.29 is the next test for this rally. A lot of people are saying that this has mostly been a short squeeze and that that's over now. Well, time will tell. We'll see what happens.
All right, I want to get your opinion in here, Nick. What levels are you watching on the S&P going into next week's OPEX?
Yeah, Patrick. On SPX right now, spot price is 43.80 approximately. We have a call wall just above at 4,400 and a put wall below at 4,300. The implied move for the November 17th monthly OPEX, which is next Friday's OPEX, is plus minus 65 points. Thus, the implied upper move would be 44.45, and the implied lower move would be 43.15 approximately, just above that key support area of 4,300. Now, I'm inclined to think that watching the volatility decline into the monthly OPEX, we probably see some range-bound action. However, next Tuesday and Wednesday, we have core CPI and then PPI on Tuesday and Wednesday, respectively. That will likely cause a large movement in markets into monthly OPEX.
Yeah, it's interesting. That's that big thing of will the gamma pinning prevail, or will the headline inflation drive that volatility? It's certainly the thing to watch. What we do know is that the shorts got squeezed. I mean, there were some historically high levels of short positioning, and everyone is now being forced to cover that. That has been the tailwind, including a Vanna influence from the OPEX that has driven this rise. So the question now is, how do the bulls hold the line during a consolidation phase? The way I look at this is that if during any pullback, 4,300 more or less contains almost all pullbacks, then it's very likely that we have seen the low of the fourth quarter and that a trade range going into the holiday season becomes the prevailing trend. I still overall am bearish this market, but if this does consolidate in here, then it really looks like it's going to be a 2024 story. Moving on, though, what levels are you watching on the Qs?
So right now, spot price on the Qs is approximately 373. We have a call wall above at 380 and a put wall below at 365. The implied move for the November 17th OPEX is plus minus 8 points. Thus, the upper expected move is 381 and the lower potential move is 365. Key resistance right now is above at 380 and key support is just below at 365. Again, as I mentioned in past weeks, I'm hesitant to go long on big tech because a lot of these big names are very, very overvalued in my opinion. Right now, what we're seeing is a lot of pausing in the call walls on certain names. Only about half of the Mag 7 names have a call wall just above the current price. Like Apple, for example, has a call wall at 185 now, which has moved from 181 or so. So there may be a bit more upside perhaps in the short term, but I'm hesitant to add long. I still do think that in order for this rally to have legs, we need to see the small caps outperform. Last week, they outperformed handedly. This week, they're underperforming, however. But I'm watching IWM primarily for the upside action. And again, a paired trade, I think, that would be probably pretty strong into the end of the fourth quarter would be short Qs and long IWM.
Well, that's an interesting perspective. The one thing that I would agree with is that if we were to have a trade range into the tail end of the year, and if it came in with the highs in yields and the bond market generally calming down, what we could end up seeing is that sector rotation out of the Mag 7 and into those incredibly beaten down bond proxies and high dividend yield areas, or even the beaten down small caps like you were suggesting. That kind of rotation would also likely keep the index far more range bound, as the Mag 7 plays such an important role from a market cap perspective, driving the upside. And that's a very premature speculation on whether that's the scenario, but it is certainly something to watch as we move forward here. The moving on though to the VIX. And the VIX collapsed. I mean, there was a vol crush, and that certainly created the Vanna tailwind for the market as dealers were buying back substantial short positioning on their hedges that contributed to that rocket higher. But here we are on the 14 handle on the VIX, and while we certainly can have a very low VIX over the holiday period, which tend to have low volumes and far more range-bound market, I'm actually surprised we're this low this quickly. Do you think we get to the 13 handle? What's your view here on the VIX?
With the VIX right now at approximately 1450, Patrick, we can expect about roughly 0.8% moves top to bottom intraday on SPX. What I'm looking at right now is a possible bottoming at around 1213 if we do continue higher into year end, and also if the CPI and PPI numbers come in line, which would probably lead to a further market rise, perhaps. However, the one thing I'm noticing that's very interesting is that we've contracted in just about 1 week or so from last week to this week. We were seeing ranges as wide as 51 points or so on average on SPX. This week, right now, we're seeing ranges around the 30-point range, which is very interesting to see how fast that contraction in volatility has occurred. That doesn't necessarily denote that we're going to see an expansion in volatility outside of some exogenous event coming out of left field and causing a pop in volatility and a corresponding decline in broad markets. But right now, I'm hesitant to go long on options because I think that it's possible we kind of do sit in this narrow range or grind, or sorry, not grind, but drift higher, toward around 44.50 perhaps. Possibly stay in this range between 4,300 and 44.50, and it may just keep bouncing back up and down and causing a lot of confusion for bulls and bears. Now moving on to page 7, we have the US dollar index. What are your thoughts here?
We're back in the 105 to 107 consolidation range after just one daily close below 105 hinted that perhaps lower numbers are still to come. But so far that looks like a fake break, and until the market moves below 105 or above 107 and stays there for a few days, we're still in a sideways consolidation.
Eric, for me, when I look at the dollar and this consolidation, it fits that bigger intermarket risk-on narrative, which is typically rising dollar stresses risk assets, and a dollar in consolidation is a tailwind for risk assets. And so if we are going to have a period where the remainder of the year is far more of a calm market environment, then the dollar being in consolidation fits the bill there. I just don't anticipate the pullback being very deep. Looking maybe at worst down to 104, but the 105 level could very well be the bottom of the range, particularly if we see the US dollar yen ripping north of 152, as all the cross currencies may not be moving in unison. It'll be interesting to see, but I think a further consolidation will just lead to an interesting buy-on dip in the dollar index.
Now moving on to page 8, we have the gold futures chart. Eric, what are your thoughts here?
We're approaching a really critical level here around 1950. First of all, the sell-off was easy to see coming if there was a geopolitical de-escalation, and I explained that in last week's commentary. So we got the de-escalation, and therefore we got the sell-off in gold, just as I predicted. But here's the curious part. At the same time as geopolitics were de-escalating, a very strong consensus was forming in macro circles that the bond market bottom is in, and therefore real rates have peaked. I'm not sure I agree that the final bottom is in for the bond market, but the fact that consensus now thinks that real rates have peaked was a huge buy signal for gold, confirmed by quite a few notable pundits making that buy call on Monday and Tuesday. But gold continued to sell off hard through Wednesday, despite the very bullish sign that real yields may have already peaked. The only explanation I can come up with for why that would be happening against the macro news is that CTAs have a massive influence in this market, and if the algos were tripped into flipping short on the collapsing war risk, they may have simply overpowered the macro-driven buyers of the shiny metal. As of the European Open on Thursday, we're just above a key support level formed by the 200, 100, 55, and 34-day moving averages and the 38.2% Fibonacci retracement level, which are all clustered together between 1934 and 1950. My hope is that this cluster of support will contain the selling. The bullish macro view, which I agree with, that real yields may have peaked, will take over and gold will reverse course to the upside. But if we get a daily close below 1934, then it could be a lookout below situation. And if you believe the market lore that all gaps must be filled, well, there's still a big gaping gap from the October 7th event way down at 1848. That's fully $100 below the current market. The other support levels on the way down are the 50% Fibonacci retracement level at 1922 and the 61.8% Fib level at 1829.
I look at gold a little more simple. With such an extraordinary run in gold in the month of October, it is very technically common to have mean reverting corrections. And here we are near a 50-day moving average. We easily can drop down towards the 1900 to 1950 zone. But this reversal was meaningful, and it'll be really interesting to see whether the bulls can hold the line and defend all further corrections, and whether we see the price action start to consolidate back toward 2,000. If we do, that would be generally pretty bullish. And so let's see whether or not the buy on dip happens here.
Now, Eric, earlier on, you mentioned you had some thoughts on fixed income. What's on your mind here?
As I noted in the gold commentary, there's a growing consensus that the bottom is in for the bond market. Peak yields are behind us, and it's all uphill in price and downhill in yields from here. I'm not sure I agree on the bottom call longer term, but in the short term, it seems clear that a new bond market rally is in play. On a related note, we got a few emails after Harley Bassman recently got a huge amount of attention in the trade press for his PFIX ETF, which offered a convexity-efficient bet on higher interest rates and has returned over 200% to investors over the last 18 months or so. Several of you have asked us whether that's the same strategy Harley described in his September 14th MacroVoices interview. The PFIX ETF is not the MBS strategy that Harley described in that MacroVoices interview. PFIX is a bet on higher interest rates, and the reason for the outsized returns was that Harley nailed the call on higher treasury rates before the big move toward higher yields actually began. But PFIX is still, at its core, a bet on higher interest rates. So PFIX only makes sense to buy now if you think rates are headed still higher, or if you're buying duration and want to efficiently hedge the risk of being wrong. The strategy for trading mortgage-backed securities to get higher yields than investing in treasuries, which Harley described in his September 14th MacroVoices interview, is a completely different animal. Now, that product just began trading this week under ticker symbol MTBA, Mike Tango Bravo Alpha. And to be clear, there's no reason to expect 200% returns on MTBA just because it's managed by the same guy who came up with PFIX. MTBA is a much more conservative strategy designed to beat the U.S. 10-year Treasury note by about 150 basis points annually. It does that by employing the unlevered mortgage-backed security strategy that Harley explained to MacroVoices listeners in his September 14th interview. That product began trading this week at $50 and is expected to deliver a dividend of about 25 cents per month. It's a strategy to consistently beat the yield of the U.S. 10-year Treasury by about 150 basis points as a core fixed income holding, not as a speculative instrument, as was the case with PFIX.
Yeah, Eric, on page 9, I have that 10-year Treasury yield, and we can really see that rejection at 5% happen, and now we're seeing us correcting off of this level. It'll be really interesting to see whether the highs of bond yields are in for at least this year, and if they are, what will that impact be on risk assets, particularly those bond proxies that are most sensitive to it. But I also included on page 10 that chart of the PFIX, and Harley's product has just had a great run on the upside, but just in its very name, it's a interest rate hedge, and it's meant to be often paired with being long bonds. And nonetheless, it worked spectacularly. It'll be interesting to see whether or not that is a short-term high at the same time if yields have peaked. Nonetheless, I wanted to wrap up by looking on page 11 at the natural gas futures. I particularly highlighted the December one. And what one would naturally think is that these going into the winter season, that there would be room for a lot of these natural gas contracts to potentially rise. Certainly, as we're rolling up the term structure, the continuous chart will have that effect. But when you're looking at that December or the January contract, here we're breaking to lower lows. It's really interesting to see how nat gas continues to be actively distributed. There's simply no sign of a bottom here. It'll be interesting to see whether or not this finally turns around, or whether there's still one more leg lower going towards $3 here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this week's Research Roundup, you're going to find the transcript for today's interview and the chart deck we just discussed here in the postgame, including a number of links to articles that we found interesting. So you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners, and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter at Eric S. Townsend, that is Eric spelled with a K, and follow Patrick at Patrick Ceresna. On behalf of Eric Townsend, Patrick Ceresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.